I remain concerned about high inflation and believe policy should be leaning against it. After last week's meeting, I see monetary policy as barely restrictive, if at all, and it's not obvious to me that monetary policy should do more at this time.
The Cleveland Fed President Beth Hammock arguing inflation remains a bigger risk than the growing signs of U.S. labor market weakness that are rattling markets today. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks extending the slide on Wall Street after private data showing the biggest October job losses in more than 2 decades. But treasuries are inching lower in Asia as Hammock and other Fed officials warn that lingering price pressures are a higher priority. We'll get insight on the inflation versus labor market debate and what the Fed will be watching with former RBI Governor Raghuram Rajan. Also ahead, veteran emerging markets investor Mobius will be joining us with his take on how the global trade tensions and worries over a potential AI bubble are impacting his asset allocations. And millions of people in India's poorest state begin voting in a contest seen as a barometer of Prime Minister Modi's support after a tumultuous year in office. We'll assess the BJP's chances of retaining power in Bihar with Asia Pacific Foundation Senior Fellow Michael Kugelman and the founder of Ascendia Strategies and VoteVibe, Amitabh Tiwari. Our top story today, the relief rally in stocks proving to be short-lived, putting the MSCI Asia-Pac Index on track for its first drop in 3 weeks. Traders are weighing persistent concerns over stretched AI valuations as well as signs of a cooling U.S. labor market. That's after an outplacement firm reported that American companies axed the most jobs last month for any October in more than 2 decades. The figures go against Fed Chair Powell's recent characterization that there's only a very gradual cooling in the job market. For more on the reaction, let's bring in Bloomberg MLive Executive Editor Mark Cudmore. What's your take? I mean, the way I look at it, perhaps it's just taking money off the table.
I think that's right. I think there's growing concerns out there, whether it's the real economy in the US, whether it's about some of the kind of frothiness in the AI bubble, some of the investment themes that are there. And you've just seen extraordinary gains this year. So I think that with a little bit more of those risks into year end, there's reason for people to take some profit. I guess the big issue for everyone to wonder is this like a major turning point or is this just a setback? And to me, I'm very much in the camp that this is just a setback. This is not the end of the bubble. And I think we're in a bubble that's going to end really nastily at some point. It's going to end with a major repricing of stocks in particular. And mainly that's around the US, but it'll be a global phenomenon because obviously there's a correlation there, particularly in risk aversion. I don't think we're at that stage yet. In fact, the price action, given the growing risk, is actually quite supportive. And we've had so little volatility over the last 6 months or so that people are just going, hyping up this bit of volatility. But really, this is quite mild still. I would expect in the short term we can see some more downside, but this is not the end.
Mark, I just want to break the trade data out of China. China's October exports in USD terms falling 1.1% year on year. The estimate was for a growth of 2.9%. So missing estimates, right? I mean, you take a look at the China markets, well supported. Do you think the trade numbers are going to impact sentiment?
I don't think massive in the short term. There's two things that are interesting here in context on either side. One is, I'm going to sound like an economist here saying two sides here. But like one is that, the trade numbers from China have actually been pretty good this year and held up very well. Now, what is interesting, if you want to get more concerned about that latest data print, is if you look at the shipping data, we got all excited about 6 months ago in the height of the trade war in April. The shipping data from China to the US has collapsed to a multi-year low. And I think that people kind of stop looking at that data. Now, is that going to sustain or not? Or is this a sign that actually people front-loaded their exports from China to the US to get ahead of tariffs? That theme is now played out. And now they're going, you know what, we found new sources. And maybe China-US trade has taken a material, damaging from the past year, and we're not going to see it recover.
Mark, thanks so much for that. Bloomberg MLive Executive Editor Mark Cardmore there. Let's get insights from our next guest, who is a senior figure in economics and finance. Raghuram Rajan is former Reserve Bank of India governor and currently a professor at the University of Chicago Booth School of Business. Prof, always good to have you with us. First off, this debate about inflation, is it being underappreciated at this stage, you think?
I think the numbers are going to get worse. That's for sure. The question is how much. And if you look at the amount of pass-through that has to happen in the United States, there's about a percentage point and change that has to be passed through directly from the imported goods into prices. About a third to a half has taken place so far. There's another 50 to 60%, which has to come through. And that means inflation going into the middle of next year is going to be higher than the current 3%. And it's close to 4% on a 3-month basis. So it is going to be high and much higher than what the Fed feels comfortable with. So the Fed is cutting into an inflationary rise. And that, of course, is one source of concern, especially given what you just heard, given that financial markets are booming, given that credit markets are booming, credit spreads are very thin. And so the Fed is, at this point, adding fuel to that. Now, the Fed's argument, which is not irrelevant, is that labor markets are weak. And we saw today some signs of greater layoffs. The good thing about the labor market so far was, lower hiring, but no layoffs or very limited layoffs. Now you're seeing some signs of layoffs, and that would cause a lot of concern, both amongst the authorities, but also amongst the public. Right now, those who have jobs are pretty comfortable, but if they fear for their jobs in the United States, it is going to put a dampener on consumption, which has been a big supporter so far. So
you talk about the layoffs, Amazon cutting 30,000 jobs. You have UPS cutting 30,000 jobs as well. The question that's being debated right now is whether or not inflation is a bigger risk than the labor market. What's your take? Where do you stand?
Well, to my mind, I think there's a third risk also. So let me add the economist's alternative, which is that it's not just the labor market, it's not just inflation, it's also the financial markets, which are very buoyant. You just heard your last guest talk about the potential for some, bubbles building up and some kind of collapse down the line. Well, think about that. That's a huge concern if it happens. I'm not saying it's on its way. What I'm saying is the cost of a credit-fueled rise and then a collapse down the line is going to be enormous for not just the United States, but the industrial world. And there's not that much fiscal space to deal with a crash of that sort, of the kind of fiscal space we had during the global financial crisis and the kind we had during the pandemic. That's just not available right now.
Before we touch on the possible collapse, I just want to finish off our conversation on inflation. You talk about how it's going to get worse. Question number one, is 3% the new 2 because the Fed is cutting at 3%? And are we possibly looking at 4% perhaps in 2026?
No, the only way that Fed can justify this, I don't think it's changed its target. It is still 2. But I think the way it would justify this is saying, one, labor market conditions would indicate that with a weakening labor market, we will see a downward pull on inflation. Yes, inflation will go up in the short run. That comes from these tariffs and pass-throughs, etc. But it will get pulled down. And that's why we're cutting, anticipating that we don't want too much weakness in the labor market, just enough to get inflation back on track. So I don't think if you shine a light on any one of the Fed governors, they will say we've abandoned a 2% target. They will just say, look, we think we will get there, but at this point, we think that we don't want too much labor market weakness, and we're trying to build insurance cuts against that.
We talk about how this is an interdependent world. We just heard how China's trade data has come in weaker than anticipated. I mean, what trickled through may we see perhaps on the U.S. economy? We talk about inflation. Is that inflationary for the U.S.?
China is in fact at this point disinflationary for the world, right? I mean, it's not just the areas where the old areas where China has excess capacity, and we just heard it's not able to export it directly to the U.S. Yes, there is a substantial amount of transshipment happening, and we have to see what happens when the U.S. Sort of starts attacking transshipments from China via other countries to the United States. But there's also this very real question that countries across the world have. If, in fact, Chinese final exports to the U.S. are falling, where are they going? Are they coming in our direction? And will they be disinflationary for us because, more capacity, more production is going to be disinflationary? So the rest of the world is already suffering from, lower U.S. demand for their goods, and to that higher Chinese supply. And you've got a disinflationary force acting in many, many countries. Does give their central banks room to cut rates, but is also a source of concern for growth, which they will worry about.
Professor, we heard earlier from Geeta Gopinath, who sounded a note of caution. She talked about how the world is pretty reliant on the U.S. economy and also the U.S. market. And if that were to collapse, we may see a destruction of $35 trillion of wealth. What's your take on it? I mean, do you share her view? What are your own concerns?
I think that right now it's anybody's guess how soon the returns from AI will come. And clearly a lot of market action as well as real investment is predicated on those returns showing up sooner rather than later. The history of past technological advances is that the anticipation of the returns is high, but the actual delivery is much further down the line. It shows up, but much later. As for example, we're seeing the benefits of the internet, the dot-com boom, maybe really in force 10, 15 years after we thought it would actually show up. And I think similarly, it may be the case that the returns from AI may take time. Now, of course, there are people who point to the fact that OpenAI has got such a large clientele so quickly that, we are seeing some of the returns show up. For example, in these very layoffs you're talking about, that it may be that because the layoffs of corporate staff, companies are finding ways to do things more efficiently. I think at this point, it's anybody's guess. I don't think anybody really knows how quickly these returns will show up, and will they sort of be enough to offset the enormous costs of investment, the depreciation, the energy costs that are going into AI. I think we have to wait and see. But often it's the pace of growth that worries people rather than just the levels. And the pace of growth has been substantial over the last few years in this area. And so, the sentiment is it looks bubbly, but I doubt anybody can tell for sure.
I'm just wondering if, what early warning indicators are you looking out for?
Well, we saw from the dot-com boom that merely an increase in real estate, in stock prices, it's not as worrisome if it is also accompanied by an enormous amount of investment fueled by credit. That was what we saw during the global financial crisis, a combination of higher asset prices, including financial assets, but also funded with a lot of debt. And when both those occur together, when the asset prices come down, what you're left with is excess debt and a hangover which is very hard to clear in the short run. So the worry is that we're moving at this point steadily from a fairly reasonably levered corporate sector in the United States, a fairly circumspect banking sector, and a household sector which hasn't borrowed too much, especially because their largest source of borrowing, which is against their house, mortgage rates have been really high and have prevented that kind of excess borrowing. But I think as you see the Fed cutting into this environment, the worry is if credit picks up strongly at this point, more so than what is already out there, and it starts funding some of this investment that's going into, for example, AI, but also not just data centers, also the energy supplies that are thought to be necessary to fuel the AI. I think these are the kinds of places where disappointment can result in both asset prices crashing. What would the price of data centers be if there's no demand for it? Plus the concern about debt against it. Who's going to repay it? So far, it hasn't been big because a lot of these big, AI players have funded it through internal cash flows. But now they're moving into funding it with debt, and more players are moving into that. We have to see how far it goes, and that's why I really worry about the financial excess as the third concern over and above inflation and weakness in the labor market.
Professor Rajan, hang tight. Former RBI Governor Raghuram Rajan, please stay with us as we turn our attention to India and the RBI's efforts to boost the economy and support the rupee. Keep it here with us. This is Bloomberg. Welcome back to Inside. The Indian government and its central bank are discussing the creation of larger lenders to help fund the country's rapid growth. Finance Minister Nirmala Sitharaman says merging existing banks is just one of the options being discussed. The plans are driven by Prime Minister Narendra Modi's ambitions to transform India into a developed economy by 2047. Raghuram Rajan, former Reserve Bank of India governor, is still with us. First off, Professor Rajan, your take on the Indian economy. I'm asking because when you take a look at the currency, it's among the cheapest in the region. What's going on there, you think?
Well, it was one of the strongest for a while, right, last year. And so I think it's a little bit of reaction. Clearly, it may be some of the issues with the United States are weighing on the currency, more as, I think this is hopefully a short-term fracas between India and the United States, that they will figure out a way to deal with both the oil issue, which I think the United States has raised, India buying oil from Russia, and of course the wider issue of trade and the imbalances right now between India and the US on goods. Hopefully, they will do a deal at a much lower level of tariffs than 50%, which is what it is right now. And it's more like the East Asian level of between 10 and 20%. That certainly will give a boost to the Indian economy. Not that trade with the US is that big. It's about 80 billion in Indian exports to the US in terms of goods, and about 40 billion in imports. So the trade deficit is about 40 billion, which is 1% of GDP. Not a huge deal as far as Indian growth goes, if some of that is upset, but certainly affects some sectors significantly. And that's a big worry. Sectors like textiles, which have gotten used to selling into the United States.
Would you say that the weakness in the rupee is helping to buffer the impact from U.S. tariffs?
It's small, and this is why I said, part of the issue was the rupee was quite strong, through last year when the dollar was strengthening against most currencies. The rupee held, broadly held its own against the dollar. Recently, it has weakened, and you're right that could be moderately helpful. But I think the bigger issue for India really is it's very hard to see the rupee weakening enough to offset a 50% tariff level. So that's not going to make India competitive vis-a-vis other countries in exporting to the US. That 50% has to come down significantly. But broadly speaking, on the overall growth side, India is doing pretty well, between 6.5 and 7 this year. And, that's not a number to sneeze at. The details are a little weak, but overall, I think it's a good number.
But, Professor, it is about job creation, right? In India, that's part of the problem. There's a sense out there that perhaps, India is wasting away its demographic dividend simply because jobs cannot be created enough for the young people.
That's the huge issue. That's the central issue in the Bihar elections, which are going on right now. But a huge issue for India is how do you create jobs for the young people entering the labor force? As you know, every Asian economy really got a growth boost when it provided those jobs and had many more people entering the labor force. The dependency ratio goes down and growth picks up. Now, India is not creating enough jobs. Now, we have to, in India, think very sensibly about how that's going to come. It's not going to come from the goods exports of the kind that China or even Vietnam did. That's a very competitive and increasingly automated area. And of course, it's now being hit by enormous waves of protectionism. I think for the masses, creating jobs means creating more rural service, creating more urban service jobs. And how do we create those urban service jobs? How do we skill up people to do those jobs of carpentry, plumber, masonry? All that stuff is something that every government in India needs to think about.
Professor Rajan, you touched on the Bihar election. How closely are you watching it? What are the implications, you think?
Well, I'm watching it at a distance, so I don't want to pretend to be an expert on the details of the election. But it clearly is a very important election for India because, in the 2024 election, the opposition seemed to gain substantial ground vis-a-vis the ruling party. The ruling party actually went into having to form a coalition with other parties in order to have the majority in parliament. Since then, the ruling BJP party has won many of the key elections that have been held, and Bihar is one election where the opposition thinks it has a chance. And of course, therefore, it is going to be watched keenly. Does this upset the momentum for the BJP? And does it then augur for the elections coming next year? Or does the BJP sort of continue with its juggernaut-like progress?
Great perspective there, Professor. Always good to have you with us. Raghuram Rajan, former Reserve Bank of India governor. Still to come on Inside, my conversation with DBS CEO Shan on the outlook and strategy after its latest earnings topped estimates. Plus, the impact of AI on the bank's workforce. That's all coming up. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. We're keeping an eye on shares of Singapore banks in the thick of the earnings season. OCBC shares are rising after the lender posted higher than expected profit in the third quarter. That's as strong wealth management fees helped offset the decline in lending income. UOB shares also in focus after the lender set aside its biggest ever provision of $470 million, citing commercial real estate risks in the US and Greater China. Meanwhile, DBS shares on Thursday touched a record high after higher than expected third quarter profit. That was thanks to sustained momentum in its wealth management business and robust trading income. Earlier today, I spoke with DBS CEO Shan as the bank looks to take advantage of an influx of institutional funds diversifying into Asia. She also explained why she doesn't expect the dollar's dominance in global finance to end during her lifetime.
a lot of the directional winds will be on where interest rates go. For DBS, we've already factored in lower Singapore SORA rates, and that's because Singapore rates have already gone down a lot more than the US rates. US rates have been 2 rate cuts. We're looking at 3 rate cuts. For us, actually, if US dollar rates go down, our cost of funds go down because we have a net floating liability in US dollars. So actually, it's not a bad thing for us. It's actually a net positive. We've already suffered the lower Sing dollar rates. And so the key thing is for next year is how do you keep the volume growth going? But that's deposit growth. How do you keep the wealth management momentum going? That's both net new money, new to bank customers, as well as more, bedding down of these wealth management clients. And then the big sort of other vertical growth area, I believe, is the financial institutions group. Global investors are now looking to diversify. Many are looking towards Asia, Singapore, Hong Kong, China, etc. And that's our game to win. So really, we've got to kind of increase our penetration of the global institutional investors as well.
The wealth business has been a boon for DBS. We're seeing lots of wealth creation in the region, especially in Hong Kong, where IPOs are closing in on $40 billion. Is Hong Kong the key market for you when it comes to the wealth business and where growth is going to be?
Hong Kong is a key equity capital markets hub. It's the largest equity capital markets in Asia. There's more IPOs there than anywhere else in the world. And there's a lot of wealth creation in Hong Kong. Hong Kong is back, right? Hong Kong is buzzing with activities. Hong Kong has the resiliency that one should never underestimate. So Hong Kong is back. And that's great because we're, the 4th largest bank in Hong Kong.
Do you see the need to perhaps tap into other markets, Indonesia, Taiwan, India, where there's a lot of wealth creation as well? Do you see that as part of your strategy?
Yes, these are all our core markets. And in all our core markets, we have a onshore wealth strategy. And it's a phygital strategy. So it's both digital and physical. Because we believe that to bank the growing onshore wealth in the middle class and demographics in Asia, you have to start early. You have to start before they become too rich. You have to give them a holistic proposition so that when they start thinking about their wealth, when they're younger, you give them a digital wealth. Sort of for the millennials and Gen Z digital wealth offering. And then once they get older, they have children, they have families, you start to create a more holistic estate planning plan, mortgages, etc. And then as they become richer, they set up family offices, etc. You give them a completely different, sophisticated offering.
No doubt DBS is big in AI. In fact, it's one of the first banks in the world to embrace AI. How are you building your capabilities?
So we started this journey, Haslinda, pretty early, 2014. The 2 big things you need to do. The first is get your data in order. So we've created a data lake in 2016. That just is an evolving journey. We created protocols and processes and security guardrails to make sure our data is clean, it's pure, it has security guardrails, how we use it, etc. That's important. It's not easy. It's not trivial. We've spent years doing it, investing in it. So that's the data. The other is your people. How you organize your people is also important. If you work in vertical silos, you're not going to use the data in the correct way. You've got to create horizontal organizations and horizontal journeys to make sure that we get the data in. It's part of your everyday way of doing business. We call it managing through journeys. And if you manage through journeys, you've got your data live dashboards, you've got product, tech, operations, HR, legal, compliance, all working horizontally to make sure that that particular client journey, it could be account opening, it could be getting a credit card, it could be an SME account opening, it could be anything. But if you work in these horizontals, then you can make sure end to end, your data, your AI, your models, working, not working, you get a feedback loop. That's important. It's also, again, not trivial. It takes years to do.
People generally, including Wall Street, is pretty divided when it comes to AI. Jamie Dimon says, embrace it. The likes of Weber say that, it's going to be the cause of further inequality. How do you balance the benefits and the job angst in particular when it comes to AI?
Deal with it head on. I think dealing with it head on is better than sugarcoating stuff and pretending it's not going to happen. So our take is be upfront. Every town hall I have with my colleagues, it's all about how do we learn this? How do we embrace it? We are coming up with a transformation festival next week, and that's all about training our, tens of thousands of employees to make sure that, okay, if your job's going to change, this is how it's going to look. Therefore, if you're in service, you're in the call center, you might want to think about how do you morph into a relationship manager, for example.
Give us a sense of, the number of workers who have been redeployed because of AI, because you talk about how you're adapting to what AI brings to the table. How are you looking at it as a company?
So we're looking at jobs that will be replaced and saying, we won't hire anymore for those jobs, no permanent hires. And if that's, being used by contractors when the contracts are up, we may not renew it. And then those who are in those jobs that will be changed, we'll have to take them out of their jobs and really start training them, which is what we've been doing for years. I mean, think about bank tellers, people not using cash anymore. So we started training bank tellers to become video ATM relationship managers, for example. That was also a journey. And it's sort of telling our staff, embrace it.
There's a lot of talk in the market about de-dollarization. It is quite interesting how DBS came out with a report suggesting that, the Singapore dollar could be at parity with the USD by 2040. I mean, talk to us about the thinking behind that. I mean, and when it comes to de-dollarization, do you see that happening right now?
Honestly, no. Because the dollar is still the dominant, currency of choice. It's still the dominant currency for trade, for investing. Look at the market cap of the U.S. The U.S. is now almost three quarters of the world's market cap, 70%. So it's hard to replace. It'll take years. Having said that, though, there is a world for diversification. There's been a concentration of wealth in U.S. dollars, U.S. stocks, U.S. bonds, and there is a time to recalibrate that concentration and think, hey, should I diversify? And I think that's happening. Whether it's diversification for supply chain, if you're dealing in the Middle East and China, is there a need to go through the dollar, or can you do RMB, for example? And we're seeing a growth of the use of RMB for supply chain financing when you don't need to go through the dollar. We're seeing that trend. We're seeing a trend of diversifying your currency in your bond market away from just US dollar bonds to perhaps having euros or bunds or JGBs, for example. That's happening. And you're seeing a diversification of equity investments, potentially out of, very highly priced US stocks to Asian stocks, which are maybe a little bit cheaper. So you see that sort of macro trend happening. But, to replace the dollar is it's not going to happen, I don't think, in my lifetime.
And that was DBS CEO Tan Su Shan speaking to me earlier today. Pretty candid about that. Now, turning now to the U.S.-China trade tensions, Business Council President Sean Stein says commercial engagement between American and Chinese companies is beginning to pick up, following the truce struck by Presidents Trump and Xi last week. But speaking to us at the International Import Expo in Shanghai, Stein also noted that companies still feel they're not yet completely out of the woods.
Yeah. 2 days after Geneva lasted 48 hours before it melted down. And I think Madrid lasted about 10 days before we started to have real problems. And so while there's hope that this time it'll continue, there's still going to be a lot of guarded, cautious optimism, at least until April.
Taking a look at China's exports data that dropped at the top of the hour, both exports and imports growth slowing significantly compared to the previous month. Let's bring in our China correspondent, Min Lo. And Min, seems like the strong upside surprise we got from last month's data is not sustainable.
Yes, definitely quite an unexpected blow to China's trade data, because we were expecting exports to grow by 2.9%, but we got a decline of 1.1%. Granted, a big part of it was because of the high base effect, really exceptionally high numbers that we got this time last year. It was the highest in more than 2 years, because that was when the front loading had just begun over anticipation that President Trump could possibly win the election. So we have seen many months of exports front front-loading, and it looks like overseas importers of Chinese goods were taking a little bit of a pause. The good news, though, is that President Xi and Trump did meet, and they have agreed to lower the fentanyl-related tariffs by 10%, which means maybe we could see a pickup in trade flows towards the end of the year. But analysts are saying that even that moderating effect is not going to be too impactful, especially if you consider that China's official effective interest rate, effective tariff rate so far is still quite significantly higher than other countries in the region, especially some of these Southeast Asian countries. So yes, we're seeing definitely a steep decline in trade flows with the US, although China has been trying to increase its trade flows with the rest of the world.
And Min, we're getting price data this weekend as well. What are we expecting?
Yeah, price data as well, not looking too hopeful. Yes, we are expecting an easing in terms of the deflationary streak. So CPI expected to come in at negative 0.1%, better than the previous month, but still in negative territory. Same thing for the PPI, expected to come in at negative 2.2%. And this is a very long streak, right? We've been in deflation on the PPI front since early January of 2023. So it's been 2 years, about 10 months now. And again, the government has been trying to change this by taking all sorts of measures to boost domestic demand. But according to our Bloomberg economics team, a big factor is because of the widening income gap in China. It's been widening consistently for the past 10 years, which means that this is a structural issue, not a cyclical issue. And that is one of the biggest barriers to why the government measures so far, the subsidies so far, perhaps has not been enough, because the poorest people in China, their incomes are just not catching up fast enough, and they are the ones with the biggest propensity to spend. So the key is really unlocking the income growth for the lowest income group in China.
Min Lo, our China correspondent, thank you so much for that. Now, staying with China, the MSCI China Value Index is on track for its best quarterly run against a growth gauge since 2022. Investors are redirecting flows as uncertainties linger over the trade deal with the U.S. Let's bring in Asia Equities Managing Editor Lian Ting Tu. And Lian Ting, this renewed interest in Chinese value stocks, what's really driving that?
Yeah, so I would say, first of all, it's a global trend, right? What makes China special was that China's AI stocks actually did so much better this year versus the Mag 7 in the US. So now, after 3 quarters of blistering rally, people are finally realizing, okay, valuation has really caught up and earnings are still not showing, strong growth. It's time to hit a pause button and think about some other sectors that are a bit cheaper. So value stocks now naturally become a choice. And we're looking at the likes of energy stocks, which are still cheap, and the banking stocks offering very good dividend yield. So that's one thing. The second thing I would say is a factor in China where, investors cannot get more margin loans to buy stocks if the stock's PE ratio hit 300 times. That's a very, very high bar. But some of the stocks did hit that. The likes of SMIC a few weeks ago. So stocks tanked because of that too. So people realize there is a bit of a cap on how far the stocks can go.
It's been a pretty volatile week, to say the least. I mean, we've seen the sell-off in global stocks, yet Chinese stocks have been pretty resilient, right? I mean, What's supporting that? What's providing that support in the market?
Yeah, I would say one thing is the driver for China's AI rally is quite different versus the driver for the rest of the world. China is more self-reliance, right? And Jensen Huang this week alone said China's going to win the AI race versus the US. So that's really boosting the Chinese market overall. And it's not just the stock market. If you look at the yuan is close to hitting the highest since April against a basket of other currencies. And the Chinese dollar bond, I don't know if you saw yesterday, getting so much demand and traded really well in the secondary market. So this is a manifestation that people really think China has what it takes to really win the AI and technology race.
And also there is a new trade emerging between 2 Chinese internet stocks. We're talking about Meituan, Alibaba. What's going on there?
Yeah, I mean, that very interesting trading strategy behind it. If you had longed Alibaba and shorted Meituan this year, you would have pocketed 130% gain, right?
Not too shabby.
Not too shabby. So the reason is, so these 2 stocks or companies are in the food delivery sector. But Alibaba has pivoted early on to focus really on AI. It has said a few quarters ago that it's going all in AI. But Meituan, not quite, because food delivery is still very much its key business. There's nothing else. So Alibaba shares are up 100% year to date. Meituan down 33%. That's how we get 130%. And Meituan, according to UOB analyst, is going into even lower margin business, which is building warehouses for its quick commerce business. So that's not really boding well. Investors don't like that. That will show up also in its earnings results. Both companies have yet to report Q3, but in the coming days they will. The expectation is for Meituan to report a net loss of $2 billion or so, and Alibaba will potentially have a gain.
We talk about the resilience in the Chinese market. I mean, I'm wondering what are some of the risks right now for that?
Well, the risk is there's also a bubble in some pockets, right? Stocks, AI stocks in particular, hitting that 300 times PE, and then many of them are very close. Cambricon, I think it was like, a big AI champion, but earnings are actually, it's good, but really not supporting the valuation. So I think for some pockets of China's stock market, the rally has been running too fast and a bit ahead of itself, basically.
All right, Lian Ting, thank you so much for that. Bloomberg Asia Equities Managing Editor Lian Ting too. Let's do a check on Indian markets as it kicks off its trading day. It's been trading for about a minute. Let's take a look at the initial numbers. It is down in line with the rest of the region. The Sensex down 0.6%. Of course, the Indian rupee is the one to focus on, currently at 88.65. It is hovering close to record lows. Lots of considerations when it comes to the rupee, though in a conversation with Raghuram Rajan slightly earlier, he did talk about how, growth is still pretty much intact. It is concerns over trade between the US and China that's actually weighing on the rupee. Still to come, Tesla shareholders approve a $1 trillion compensation package. Elon Musk, the largest payout ever awarded to a corporate lender. Details coming right up. Keep it here with us. This is Bloomberg. Welcome back to Inside. Tesla gained in extended trade after shareholders approved a $1 trillion compensation deal for CEO Elon Musk, the largest such corporate pay package ever awarded.
Sixth and finally, on the 2025 CEO Performance Award to our founder and CEO Elon Musk, with over 75% voting in favor, approved.
Let's get more. Rachel Chang is Bloomberg's managing editor for Asia Global Business. She joins us now. Rachel, I mean, it is a $1 trillion package, but it comes with ambitious goals. What do we know about his pay package?
It does. I mean, the package is the largest in history ever, and it would make Musk, his net worth would be more than several countries' GDP combined if he reaches those targets. But we do know that the package bakes in very ambitious milestones for Tesla, which Musk does have to reach in order to unlock each tranche of this new pay package. So, these milestones are very ambitious. At the end of it, they're looking at Tesla being an $8.5 trillion company. Right now, it's around $1.5 trillion. So, that's a huge way to go. They're looking at Tesla delivering 20 million vehicles a year. They're looking at Optimus robots as well in the tens of millions before Musk will be able to unlock this full package. So it really is a performance-linked package. There is a lot of questions around whether Tesla can even reach these numbers given the growing competition around electric vehicles, the challenges that it's facing in places like Europe, for example. But it's very much a reset for Elon Musk. It's him kind of coming back to the corporate world, coming back in charge of Tesla after that whole political side quest. And saying, he's going to be getting really serious about this company now.
Rachel, is not surprising. There was a lot of opposition. Who was against it?
There was a lot of opposition. We did see that shareholder advisory boards like ISS and Glass Lewis did advise shareholders to not to pass that. We know that the Norway Sovereign Fund was one of the big shareholders that came out and saying they would vote against it. But ultimately, it passed by a very convincing threshold of over 75%. It does show that the big shareholders around Tesla do ultimately feel, and they agree with the board that came out very strongly campaigning for this proposal to pass, past, they agree that Elon Musk is the only person who would be able to get Tesla to these very ambitious milestones and would be able to bring Tesla into that next generation. You know, the chair of Tesla, Robin Denholm, did describe Elon Musk as a generational leader. He was the only one that brought this company to where it is now, and he's the only one that they believe can take it to the next chapter. So it really is, a confirmation and emphasis that Elon Musk is Tesla, Tesla is Elon Musk.
That's right. And, what are the prospects now? How does it look for Tesla right now that the shareholders have ultimately passed this?
Right. I mean, there's actually a lot of challenges for Tesla. You know, the Chinese car makers are advancing very aggressively across the globe. Of course, they're shut out of the US, but in every other market, including Europe, including South America, including Asia, they're coming very strongly. They are much more convincing in the lower end, the mass market segment, where Tesla has not played very convincingly because, its cars are more premium, more luxury. At the same time, Musk has talked about self-driving, has talked about the Optimus robots as well as a big part of the future business. There's still a lot of questions around robot taxis, around self-driving, although they have launched pilot schemes in a lot of places. Still a lot of questions around that technology and whether it really is scalable to the point where that they need it to become profitable. So, when Tesla began, it defined this industry, right? It created the modern EV as we know it. But this is a lot of time has passed since those initial years. It's a crowded landscape now. So I think there is a big question over whether Tesla will continue to be synonymous with EVs going forward.
Well, $1 trillion to motivate Elon Musk. Rachel, thank you so much for that. Bloomberg Managing Editor for Asia Global Business, Rachel Cheng, they're coming to us from Hong Kong. Let's do a check on how Asian benchmarks are doing under pressure, extending the loss that we saw overnight in the U.S. The MSCI Asia-Pac Index down more than 1%. It's been a volatile week for stocks, to say the least. Today, Asian equities falling, tracking that decline, sentiment weighed down by concerns of a stretch valuations, AI valuations, that is, and signs of a cooling labor market. MSCI Asia-Pac Index on track for its first drop in about 3 weeks. U.S. equity futures, let's take a look at how they're faring right now, reflecting a week in which stocks have swung between gains and losses, currently also in the negative. Markets whipsawed by a number of comments from Fed officials on rates, many focusing on inflation, downplaying the chance of a cut in December. Well, still come on Inside, Mobius Emerging Fund Chairman Mark Mobius will be joining us live in just a few moments to discuss his outlook on emerging markets. And later, our new India-focused segment spotlights the elections in Bihar. Analysis coming right up. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. I'll look at some key market themes we're tracking today. China's exports unexpectedly contracted in October as trade tensions with the U.S. spiked. Imports also slowed sharply and grew 1%, leaving a surplus of just over $90 billion. Meanwhile, we're also keeping an eye on the Malaysian ringgit after it strengthened to its highest level in over a year. That's as expectations for an interest rate cut fade and optimism about the economy grows. And Malaysia's Deputy Prime Minister says Chinese trade has been more friendly. Ahmad Zahid Hamidi spoke to Bloomberg on the sidelines of the China International Import Expo about how Malaysia is navigating its ties with both Beijing and Washington.
Centrality has played an important role, not only in terms of diplomatic relationship, but also in terms of trade and G2G as well as B2B and P2P. And to us, as we move forward right from last year, 2024, until 2028, we are ushering in new golden era where one defined by innovation, sustainability, and also high quality growth has been coordinated by Ministry of International Trade and Investment. And it is well coordinated by other ministries as well.
Does it complicate matters with China because of the trade agreement that was reached with the Trump administration just in October when Donald Trump visited Malaysia. There's been some, of course, concern in Malaysia about that, but what kind of overtures need to be made to China?
What we are doing is to have and to create understanding. What is important is the chemistry between China and Malaysia has been created for many decades. We are merely translating all this commitment into action. And then the Chinese traders normally is more friendly. They understood the multiculturalism that we embrace, as well as cross-cultural communication that we are having with the Chinese traders.
Has China issued any kind of concern about the deal that was?
Yes, they have been working with our state's government. We have 14 different states in Malaysia.
Yeah.
And basically the raw materials is under the control of the states. And the federal government is coordinating with the state. That is why we impose on the semi-finished product to be exported.
Can I ask you a domestic question a little bit about, obviously the trade minister's portfolio is going to be gone from the other party by December, I believe, as Zafrul Aziz will step down. Is that the portfolio, the trade portfolio is so important to Malaysia, as we've just been discussing? Is that something that you'd be working to get back into the fold of UMNO?
We have many talents within UMNO leaderships. But, the appointment of ministers, deputy ministers is under sole prerogative of the Prime Minister. We will obey to his choice, but we would like to propose that some of experienced ministers from UMNO can continue the good work done by Tengku Zafrul in MITI.
Malaysia's Deputy Prime Minister Ahmad Zahid Hamidi speaking to our very own Chief North Asia correspondent Stephen Angle. Well, our next guest is synonymous with emerging and frontier markets investing, with a reputation as one of the most successful and influential money managers over the past 30 years. He also has a soon-to-be-launched book titled The Digital Currency Revolution. Let's get insights from Mark Mobius, Chairman of Mobius Emerging Opportunities Fund. Mark, good to have you with us. We just heard from the Deputy Prime Minister of Malaysia how Malaysia is navigating both the US and China. I'm just wondering, when you take a look at the trade deals that have been negotiated in this part of the world, can you see who are the potential winners and losers so far?
Well, so far, I think the US has been a winner to a great extent, because if you notice the meeting that she had with Trump, Trump came out ahead in the sense he walked away with what he wanted. That was soybean exports to China. The American farmers are very important to elections. So that was one thing. And of course, the rare earth release by China, that's another thing. So a number of things happened between Xi and Trump, which put the U.S. in a much better position. And of course, as you know, Trump's visit to Southeast Asia was also very, very, very good. And then most important of all, his trip to Japan put China in I would say, pretty bad position. So a lot of things are happening. I think most important thing that is the changes within the CCP, the Communist Party of China, now is making a big shift, I believe. It's going to be a much friendlier orientation, an orientation which is going to be much more open, which makes me more bullish on the Chinese market. So on balance, the U.S. probably has come into a better position, but that doesn't mean the Chinese are going to be weak in terms of trade and that sort of thing.
So China's become more attractive. How would you be playing this market now? It does seem like, there's greater appetite for Chinese assets at this point in time. What's attractive, Mark?
Well, the technology is very, very important in China, and it's getting better and better. As you know, China has embarked on a program to be self-sufficient in chips and many other areas of technology. And that is going to be very critical for investors like ourselves. So we're going to be looking at companies that have a leg up on the US and Europe in technology. And as you know, if you look at the EV market in China, it's been incredible. I mean, you drive in a Chinese vehicle and it's better than a Rolls Royce. I had the experience recently of driving in a Rolls Royce, and then I got into a BYD, and the BYD was better. So you're in a situation now in China where the technology is getting better and better, and they're moving up the technology stairs.
Is there a convincing reversal in sentiment when it comes to investor sentiment in China? You know, it wasn't that long ago when China was actually uninvestable, Mark. I mean, is this the catalyst?
Yes, I think it is a catalyst. It's not going to happen overnight, but you can see that the Chinese market overall has been outperforming surprisingly India. As you know, I've been a big supporter of Indian growth, and now China's outperforming India. And in fact, if you look at the recent numbers, the Chinese market overall is outperforming the U.S. market. So there's no question that we're now in a different era. It's going to take time for people to adjust, for investors to adjust, because a lot of people are still down on China. But I think that's going to change going forward if the current trends continue.
So we can expect a longer-term re-rating of China. Is that right? I mean, and if that is the case, what time period are you looking at?
Looking at this year and next year, you're going to see a re-rating of China. I mean, this is all based on the assumption that the current trends, the political trends within China continue, where the hardline wolf warrior kind of approach in China goes away. And the Communist Party now is saying, look, we've got to make it much easier to deal with the U.S. We've got to be more friendly with the U.S. And that's going to change many, many things.
Right. What's the biggest risk for China, Mark? I mean, you know, investor sentiment changes with the headlines. That's how quickly they change.
Yeah, that's right. The big risk, of course, is if the wolf warrior stance that Xi has been promoting from the beginning of his term comes back. If that happens, then it's another game. But I don't think so. I think the Communist Party in the latest plenum realized that they've got to be friendly to the U.S. They've got to mend the relationship. And it's really interesting that in the meetings with Xi and Trump, Taiwan was not mentioned once, which is quite critical. That says a lot about relationships between the two countries.
I want to pull back and go back to what you were talking about, the U.S., that U.S. is the winner. Yet when you take a look at the market reaction right now, we've seen that sell-off. How are you making sense of that sell-off? Is it just a matter of removing some of the froth, especially in the AI space?
Of course, if you look at the AI space, it's a lot of froth. And we expect there to be a big correction in these companies that are emphasizing AI and spending trillions of dollars in AI improvements and infrastructure. There's got to be a correction because some of the numbers are just out of sight. So that is going to happen going forward. But that doesn't mean that AI is going to disappear. AI is still critical. But I think some of the infrastructure spending and other spending on AI is probably excessive. And there'll be a pullback on that.
What's a big pullback? What's a big correction? Some on Wall Street say, more than 10%. But what is 10% when you've risen more than 80?
No, I mean, when I look at a correction, I look at 30% down, 30, 40%. That will happen. But it will be short-lived. I mean, that's the wonderful thing about these bear markets. The bear markets are much shorter in duration than the bull markets. And that's the reason why long-term investors, if they hang in there, tend to do fine. But I think we've got to be ready for a big pullback. When it's going to happen, nobody knows. Currently, everybody's euphoric. Everybody's happy. There are a few naysayers. But generally speaking, we've got to be prepared for a pullback.
And you buy the dip, Mark, if you believe that the long-term trend is still higher.
Oh, definitely. I mean, I'd love to see a pullback of 30, 40%. Then we'll be in there with both arms and legs. We'll be buying a lot.
When you see this pullback in AI stocks, what is the value case for EMs? How do they play against each other, Mark?
Well, the good news with EM is because of the trade policies by the U.S., many of these countries are going to be producing and exporting the things that China has been producing and exporting. So if you look at Southeast Asia, for example, I think Malaysia is going to benefit from that. Thailand will benefit. Other countries, Taiwan will continue to do very well. Korea will do well. So this is a very, very critical development. And of course, India is developing entire hardware industry for computers and all kinds of electronics. So I believe that this change is going to have a beneficial effect. Now, that doesn't mean that China loses out. China is moving up the scale. They're getting rid of the low technology kinds of industries and moving up the technology scale. And they will, of course, be benefiting from that as well.
You know, we've been talking about how we will see a rotation back to EM, but we've not seen a real rotation back. You know, what catalyst, what's really needed for us to see that?
Well, if you look at the EM index, you'll see that it's done very, very well, outperforming the U.S. market, at least in the short term. And the reason for that is China. China represents such a big part of the index. But I believe India will come back. And of course, these two powerhouses will really make emerging markets look very good. And of course, that will swash over into other emerging markets. If you look at the rest of Asia, there are many markets that are doing quite well. Malaysia looks good. You can notice that the Malaysian ringgit is getting stronger against the U.S. dollar. The Thai baht looks pretty good. Of course, the other currencies are weakening against the U.S. dollar, but not by very much.
The trend so far, though, is dollar resilience, right? I mean, the Fed is not cutting as much as people thought it would. How might that impact on EMs?
Well, a stronger U.S. dollar is great for EM because they can then export and earn more dollars. So I would say that's a very positive development for EM. But you must remember, if you look at the U.S. dollar index, it's now, after having come down substantially, it's now just beginning to turn. You begin to see the index moving up, and it's got a long way to go. It's going to be getting stronger and stronger. You see the Trump policy of strengthening the balance of payments of the U.S. and, of course, all of these tariff income by the U.S. is earning now, is going to have a big impact on the confidence of the U.S. dollar and the U.S. economy in general. So this trend has just begun, and hopefully, during Trump's administration, it will continue going forward.
There's also diverging rate cycles, right? We talk about how the Fed is quite resistant, but when it comes to Asian central banks, they've been more than willing to cut rates. That would work in EM's favors, no?
Of course, yeah. They take the lead from the Fed, of course, and all these countries, as the Fed comes down with interest rates, they'll be lowering their own rates, and that will be very good for the economies. So we're in a very nice period, but when you look at the height of the U.S. market, you get a little nosebleed because we've moved up an awful lot. But I think emerging markets will follow.
You talked earlier about India, how India will be, an emerging market driver. How do you make sense of, the attractiveness of the market, the resilience of the economy, GDP in excess of 6.5%, yet it has a currency that is amongst the weakest in the Asia-Pac region? What is that reflecting, Mark? I mean, is it actually reflecting fundamentals or not?
I think the problem with India is that despite the fact that it's got this enormous domestic market, the fact that they're moving very fast up the technology ladder, the problem is the bureaucracy. Putting money into India is a terrible, terrible process. It takes months and months for us to get money into India. For one of our funds, we've been working for 9 months to get approvals. So this is a big, big problem for India. The Indian bureaucracy is really killing the Indian market's ability to absorb more and more foreign investment. Many foreign investors want to get in to India, but they've been prevented by this incredible bureaucracy. So the degree to which they're able to correct that will really be very meaningful in terms of what happens to India. And of course, we're not only talking about dollars going in, we're talking about investments going in, we're talking about technology going in, et cetera, et cetera. So this is the big, big challenge that India now has.
So for India to be supported, for the Indian market to be supported longer term, you have to address the issue of bureaucracy. But shorter term, would earnings be the driver? Would earnings be, holding up Indian stocks, you think?
Well, it has. I mean, the Indian market, companies have done very well, but they reached a peak where further growth was not possible. And that's the reason why the market corrected. And what is needed, as I mentioned, is more and more money coming in to the market, which I'm not only talking about the equity market, I'm talking about direct investment generally, companies coming in and investing. And by the way, part of this is China. India has to invite and welcome Chinese investment. Now, that may seem strange because of their fraught political relationship over a number of years, but generally speaking, China can contribute the kind of technology and manufacturing expertise that India can use to export all over the world. So this, and of course, China likes to do that because if they can't export to the U.S., they'd love to be able to establish a factory in India and then export to the U.S. So I think we're in a situation now where they have to do that.
How do you play the Indian market? We often talk about how it is a consumption play, right? This is 1 billion people. But there are opinions out there saying that, the Indians will probably get old before they get rich because, they're struggling with job creation and so on and so forth. How do you play best the Indian market?
I would say the way to play it is looking at the hardware technology. In other words, as you know, India has been an incredible producer of software. They've been exporting software all over the world. You have companies like Tata, Infosys are doing an incredible job globally exporting. Now they have to get into exporting of hardware, computer hardware. And that's the reason why this business of allowing foreign investment to come in and making it easier, foreign investment to come in is very critical. Before, software is no problem because you don't need an export permit to export software. But for hardware, it's a different story.
Mark, I just want to pivot somewhat to another emerging market, Korea. There was a lot of euphoria, right? I mean, a lot of money was being pumped into the Korean market, but it's also among the biggest losers with the sell-off. How attractive is Korea to you?
Korea is one of the most interesting of the markets right now for us. Next to Taiwan, I think Korea ranks pretty high. So we're looking at a number of companies in Korea because the Korean technology has really done very well. And in certain areas, interestingly enough, healthcare, cosmetics, that sort of thing, Koreans are doing very well.
But if you take a look at what's happening right now, the sell-off in AI, I mean, Korea is getting hit really badly. So the risks are high for a market like Korea.
Yeah, everybody will be hit with that. There's no question about that. But it doesn't mean AI is going away. They will still be developing AI, and they'll still be using AI.
What's interesting currently is how retail investors are driving the markets. We're not seeing that just in Korea, but in India and even in the US for that matter. Do you think this is a healthy trend going forward? Because should there be a sell-off, that correction of 30%, for instance, like what you anticipate later on, that could be damaging for these investors?
Well, of course, you've got to look at the U.S. market because U.S. represents, about 70% of total equity investing around the world. And one of the developments that we've noticed is that the U.S. does not reflect necessarily the U.S. economy, but the global economy, because more and more of these companies, you look at Apple, you look at Amazon, you look at any of these companies, they're global companies, they're in emerging markets, and a lot of their growth in terms of sales and in terms of supply chain have been emerging market supply chain and sales growth. So this is, you've got to watch the U.S. market, because U.S. market goes down, everybody will get hit.
Mark, always a pleasure to have you on the show. Mark Mobius, chairman of Mobius Emerging Opportunities Fund. Now, still ahead this hour, India's Prime Minister Narendra Modi facing a fresh electoral test with voting underway in the country's poorest state. A deep dive coming up into why Bihar's election matters. This is Bloomberg. Well, it is a risk-off Friday. The MSCI Asia-Pac Index down about 1.2%. Asian equities extending that decline we saw on Wall Street. Sentiment being weighed by a couple of things. Concerns of a stretch AI valuations, also signs of a cooling labor market. By the way, the MSCI Asia-Pac Index on track for its first drop in about 3 weeks. The Nikkei 225 unspared, currently down more than 2%, along with the Kospi. That is leading the pack lower by about 3% as we speak. Remember that the Kospi has had quite a run. Now, still come, our India focus turns to the state elections in Bihar, the country's poorest state. We'll look at the BJP's chances of retaining power next with the Asia-Pac Foundation's Michael Kugelman and political strategist Amitabh Tiwari. Keep it here with us. This is Bloomberg.
Bihar is one election where the opposition thinks it has a chance, and of course, therefore, it is going to be watched keenly. Does this upset the momentum for the BJP, and does it then augur for the elections coming next year, or does the BJP sort of continue with its juggernaut-like progress?
Former RBI Governor Raghuram Rajan speaking to us earlier about the election in Bihar. The referendum in India's poorest state takes center stage in our India Focus segment this week. Millions took part in the first phase of voting on Thursday in a contest seen as a barometer of Prime Minister Narendra Modi's popularity after a tumultuous year in office. Modi's BJP rules Bihar in coalition with regional parties, and it's looking to retain its power in a 243-member legislature. For more on this, Bloomberg's Maneka Doshi joins us now from Mumbai. And Maneka, put this in perspective for us, right? Why should the world be paying attention to this election?
Well, morning, Has. Bihar is India's most populous state. It's in the northeast part of India, and it has over 100 million people, almost the size of, say, Vietnam. It is unfortunately also India's most poorest state by per capita GDP and amongst the most illiterate states in India. So if India wants to become a developed nation, and if that's the core goal over the next few decades, then raising incomes nationally, most importantly in states like Bihar, becomes critical to that task. Now, politically, Bihar sends 40 members of parliament to parliament. That's to the central government. So that's an important number and a significant influence the state has. A majority of those in last year's general election were won by BJP and its alliance partner. And that combination is in power at the state level as well, as you mentioned. So they want to maintain that strength, and they want to maintain it enough to offer over $1 billion in freebies ahead of this election to woo women and young voters. This is a three-cornered contest, or maybe I should say a 2.5-cornered contest. So, like you pointed out, you've got the BJP and its alliance partner, which is a very strong regional party called the JDU, the leader of which has been the chief minister of Bihar for almost 2 decades or more. And then on the other side, you've got another strong regional party called the RJD, supported by the Congress in alliance. And then there is a third new player, Prashant Kishore, before, who used to be a political strategist, who's now thrown his hat into the political ring, and his party is expected to take away votes from both sides and potentially play kingmaker.
Manaka, great stuff. Stick around, please. Joining us now are Michael Kugelman, non-resident senior fellow at the Asia Pacific Foundation. He's an expert specializing in South Asia and its relations with the U.S. We also have Amitabh Tiwari, founder, partner of Ascendia Strategies and VoteVibe. Amitabh is a political strategist and policy advisor. Amitabh, let's start with you. We know Manaka has laid out the foundation saying that, it is a significant election for Prime Minister Modi. I mean, how much is at stake when it comes to maintaining power at the federal level?
No, essentially, if the BJP is able to win Bihar because of a series of victories in Maharashtra, Delhi and Haryana, it can press home the narrative that the setback in 2024 general elections were largely an aberration. So it could help NDA and the BJP to erase some of those losses from people's memory if they do better. If they do not, then it could put the pressure back on Prime Minister Modi and give a momentum to the opposition led by leader of opposition Rahul Gandhi, who, according to many surveys, is closing the gap with Prime Minister Narendra Modi in the popularity ratings. In fact, the popularity ratings or the gap between Modi and Rahul is now fallen to just 9%. As per a C voter survey.
Amitabh, hi, this is Menaka here in the Mumbai studio. That gap may be narrowing between Modi and Gandhi, but when it comes to the state level, do you see the Congress alliance, and the Congress is the junior partner in the alliance, making significant headway? What do you think are the critical factors at play? Because when I read your surveys, I don't see Rahul Gandhi's voter list manipulation issues dominate amongst Bihar's voting issues.
Yeah, essentially the bread and butter issues dominate, which is unemployment, migration, poverty, price rise and corruption. These are the 5 top issues in Bihar. Somehow the voter adhikar yatra or the voter manipulation charges is not resonating with the opposition voters, as in the voters of the NDA and the floating voters, is largely resonating with the core vote bloc of the Congress and its allies, which means that it may not have significant electoral impact, because for that you need to win the support of NDA or BJP and voters from other parties. See, the performance of the Congress is likely to decide the fate of this election, because it is fighting on around 61 seats. On 9 seats, there are friendly fights. And on 50 of these 61 seats, it is pitted against stronger players, you can say, in the Bihar Premier League, which is the JDU and the BJP. So the performance of the Congress party will decide the fate of the India bloc in Bihar. And if for any matter it is not able to perform well, or its strike rate is just like in 2020, then question marks would arise about the fact that the Congress perhaps is the weak link amongst the regional parties, and also there could be a question mark, or there could be voices as to who should lead the India bloc, whether it should be the Congress party or whether it should leave it to the regional parties to do the slogging with the BJP.
Michael, let's get you in this conversation. This election is happening at a time that is pretty fragile for Prime Minister Narendra Modi. We have concerns about the election. We have US-India trade negotiations also front and center. How might this be, playing out in terms of the psyche of the voters?
Well, you're right. It is an important moment. And for Modi in particular, I'd argue that he's still trying to shake the criticism that he's become vulnerable to the anti-incumbency factor, someone who served multiple terms and indeed did not perform as well as many had expected in the general elections last year. And in that sense, this is an opportunity to show that his party is still strong. And the BJP has won a number of state elections since those general elections last year. But, the Bihar election comes in the midst of a very busy state election cycle in India. After the Bihar election, there's going to be several other key elections for the BJP, including one in West Bengal, which is the fourth most populous state in India, Bihar being number 3. So I think that for Modi and the BJP, this is an opportunity to show that he and his party can maintain momentum from the last few months, and that would be good. That would be strong to take the party and the leader and Modi into these next cycle of elections in the coming months. But yes, there's a lot going on in India and geopolitically that has certainly put some pressure on Modi, though I would argue that when it comes to the trade talks with the U.S. and the 50% tariffs that have certainly raised economic concerns for India, I would argue that Modi has not necessarily lost popularity for that. I think that many in India actually applaud how the Indian negotiating team refused to give in and make the concessions that the U.S. side wanted it to make. I think that was appreciated as showing strength, particularly given that a number of other countries that did make deals with the U.S. made many more concessions. But bottom line is, there are issues happening in India, such as unemployment, for example, that have put a lot of pressure on Modi. And Bihar is one of the poorest states in India. Unemployment is a major issue. So being able to win this election despite that significant obstacle, that'll definitely be something for the BJP to have to focus on. If it does prevail, that'll be a big achievement for the BJP in that regard.
Do you expect unemployment to, I guess, tip it over for Modi? I mean, his track record hasn't been good. And as you said, this is, the poorest state out there, and it's not looking good.
Well, yeah, I mean, there are a number of issues at play in this election. Certainly jobs is one of them. And we've seen that Modi has announced a series of new welfare measures, particularly those that target women. I believe that women comprise about 50% of the voter base in Bihar. And the BJP is promising to create jobs, but the economy in Bihar is fragile. So it may not be that easy just to suddenly generate so many jobs over in so little time. But clearly, one talks about the identity politics and Hindu nationalism in the BJP agenda. I do think that for the most part, that the issues that are going to really play out and be most resonant in this election, the ones that are going to matter the most, are bread and butter issues when it comes to jobs, concerns about the economy. Those are the issues that have really been very prominent on the campaign trail for BJP.
Amitabh, I want to pick up some of the issues Michael touched upon with you. First, anti-incumbency. Your surveys seem to suggest that whilst there is significant anti-incumbency against local representatives, it isn't playing out in as much measure against the state's chief minister, Nitish Kumar, who, some might say could become chief minister all over again. What's your take on that?
Yeah, because it's often said that Prime Minister Modi enjoys a Teflon coating, but it also applies to Nitish Kumar, who is the Chief Minister of Bihar. Bihar has been one of the states which records the poorest or the lowest per capita income and is very poor on the HDI indicators. But despite that, he has been winning election after election, and despite the fact that he has been changing partners also in some of the elections. So he still continues to be popular, largely among women, and also a section of the EBCs and the non-Yadav OBCs. And the schemes which he has implemented for women, including the improved law and order situation, like the cycle distribution, scholarships for girls, reservations for women in police and other local panchayats, and now this rupees 10,000, you can say a seed capital for encouraging them to start a business. All of this has developed a core vote base of the women folk. He has been able to do that. And the anti-incumbency is largely against the government. When I say government includes the chief minister, but it also includes the other ministers, the bureaucracy officials, and the MLAs. So there seems to be some anger.
Let me ask you this. Let me interrupt and ask you this. If there is, if they believe they have a strong chance, the BJP and Nitish Kumar's party, then why this significant giveaway through freebies? Do you see that as desperation or just simply insurance to make sure that they return to power?
No, see, the level of anti-incumbency, if you see our trackers at VoteVibe, was very high it continues to remain high at 48%. People said that the level of anti-incumbency is high or there is strong anti-incumbency. Only 18% people or respondents said that the anti-incumbency or there is pro-incumbency, and 22% were neutral in July. So through a series of steps like this rupees 10,000 cash income support, what has happened is that the government has been able to turn some of the people who were saying that they are neutral about the anti-incumbency into pro-incumbency. So now in the last tracker in September, October, the pro-incumbency levels increased to 32% from 18%. So they realized that there was a discontent, perhaps because of agri-distress, unemployment, rural distress, and took these steps to improve their position in the upcoming elections.
So, Amitabh, do you think that the BJP, JDU combined will return to power in Bihar, in many ways endorsing Prime Minister Modi's popularity in India, allowing Nitish Kumar to return as Chief Minister? Is that the most likely scenario at this point, according to you?
So see, yesterday in phase one, the turnout has been one of the highest in Bihar's history. So a number which is keenly awaited is what is the female turnout versus male turnout. The female turnout historically in Bihar after Nitish has come to power is more than 3 to 5% of the male turnout. So if the same trend continues, what we have also seen is that JDU particularly has a very high strike rate in seats where the women outvote men. It ranges from 70% to 90% of the seats. So we'll have to wait for the final figures of the ECI with respect to gender turnout. If the gender turnout is fairly high compared to males, then it is advantage NDA. Otherwise, it is advantage the India bloc or the Mahagathbandhan, because youth, and primarily male youth, because the worker participation rate amongst females is low in Bihar. It is youth which is disenchanted with the government and suffering from unemployment and migration. And the male youth.
Michael, let's get your perspective on the turnout, whether it's youth, whether it's women. What assumptions are you making?
Yeah, I mean, this turnout factor is really significant. As Amitabh said, some of the highest turnout we've seen in Bihar in recent years and perhaps ever. I mean, the government figure, as I recall, is about 65%. That's significant. And I think that that's something that the opposition might latch on to and say, okay, with so many people worried about poverty, unemployment, that, the high turnout must suggest some type of protest vote against the government and in favor of the opposition. But, those that are in power now may conclude or hope that this is just a case of people coming out enthusiastically to show support for the current government. But yeah, absolutely. There's still things that we need to determine, such as, the number of women voters and so on. But basically, at this point, the governing coalition and the opposition can both point to the high turnout as something that will benefit them. We'll just have to see what happens in the second round of voting next week and then wait for the results later next week.
I'll go back to Amitabh with this question on, Prashant Kishore, who is the third corner in this challenge. Amitabh, do you think he has the potential opportunity to play kingmaker? Do you think this becomes a muddle of a government? Will it go all the way down to the wire, or will it be a decisive sort of victory for either side?
So if the Jan Swaraj party does well, then it is likely to be a closer election. The worse the Jan Swaraj party or Prashant Kishore does, then it is likely to be a comfortable majority for either of the alliances. See, it's just been 3 years and Bihar is dominated by caste politics. So he does not have a base on which he can add on vote share. Like when he advises political parties, there is already a base of that political party and you add 2%, 3% to enable them to win. So he has, you can say that, set the agenda in terms of raising issues. Some could even argue that he has raised more valid points than the opposition has raised perhaps in Bihar. And he has traction amongst youth and also amongst a large section of migrants. And there is some sort of undercurrent. So one cannot gauge as to whether this is likely to convert into votes or not. On 83 seats in 2020, the victory margin was less than equal to 5%. So if he gets anything above 5%, then he is likely to spoil the prospects of either the NDA or the India bloc. So he's likely to more play the role of a spoiler in this election. Some of the tactical mistakes I think perhaps committed is that he did not himself contest the elections, and we've not seen a manifesto from Jan Suraj Party, which is very, very intriguing.
Sure.
Okay. Michael,
one quick last question, Amitabh. Oh, Has.
Go ahead.
Go ahead.
Go ahead.
Okay, I just had this quick last question, Has. Michael pointed out the big other state elections next year. And my question to Amitabh was simply that, what happens in Bihar? Will that have any bearing on West Bengal or Tamil Nadu or Kerala? Because those are very strong opposition party-led states.
Yeah, so those are very strong opposition party-led states. And I don't think in terms of bearing, it might have any bearing, apart from the fact that, of course, it would motivate or energize the cadre of the BJP or the NDA to do well in some states like West Bengal and Tamil Nadu, where it has entered into an alliance with AIADMK.
Great conversation there. Michael Kugelman of the Asia Pacific Foundation, Amitabh Tiwari of Ascendia Strategists, and our very own Menika Doshi. Thank you so much for that. Now, still to come, DBS sees opportunity as a wave of institutional funds diversify into Asia. Hear more from my interview with CEO Tan Su Shan. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're in the thick of earnings season for Singapore's big banks. DBS shares on Thursday touched a record high after better than expected third quarter profit. That was thanks to sustained momentum in its wealth management business as well as robust trading income. I spoke with DBS Group CEO Tan Su Shan early today about their outlook.
A lot of the directional wins will be on where interest rates go. For DBS, we've already factored in lower Singapore SORA rates, and that's because Singapore rates have already gone down a lot more than the US rates. US rates have been 2 rate cuts. We're looking at 3 rate cuts. For us, actually, if US dollar rates go down, our cost of funds go down because we have a net floating liability in US dollars. So actually, it's not a bad thing for us. It's actually a net positive. We've already suffered the lower Sing dollar rates. And so the key thing is for next year is how do you keep the volume growth going? But that's deposit growth. How do you keep the wealth management momentum going? That's both net new money, new to bank customers, as well as more, bedding down of these wealth management clients. And then the big sort of other vertical growth area, I believe, is the financial institutions group. Global investors are now looking to diversify. Many are looking towards Asia, Singapore, Hong Kong, China, etc. And that's our game to win. So really, we've got to kind of increase our penetration of the global institutional investors as well.
How confident are you in countering that squeeze on margins?
Well, I think it's a balance. I mean, the margins on interest rates were a price taker. However, what we have done in the last few years is we've been very nimble on hedging. It's a little bit, if you're hedging now, it's a little bit too late. So you would have had to start years ago, and the team started years ago. So that's good. So we have hedging already, both on the interest rates and on the FX. So, if it goes really big either way, we're protected either way. But of course, next year's, new hedges will have to come in as the old hedges melt away. And so our issue will then to be finding, good opportunistic pricing to come in with the new hedges.
The wealth business has been a boon for DBS. We're seeing lots of wealth creation in the region, especially in Hong Kong, where, IPOs are closing in on $40 billion. Is Hong Kong the key market for you when it comes to the wealth business and where growth is going to be?
Hong Kong is a key equity capital markets hub. It's the largest equity capital markets in Asia. There's more IPOs there than anywhere else in the world. And there's a lot of wealth creation in Hong Kong. Hong Kong is back. Right? Hong Kong is buzzing with activities. Hong Kong has the resiliency that one should never underestimate. So Hong Kong is back. And that's great because we're, the fourth largest bank in Hong Kong. We've set up wealth centers there. That's been doing well. There's been a lot of flow in Hong Kong, both into the stock market and into the bond market, actually. So it's both. Singapore, as a wealth hub, has also done well. It's more of an FICC market, fixed income, FX commodities. But both financial hubs have seen great activity.
And that was DBS Group CEO Tan Shu Shan. Before we go, here's a preview of our shows next week. Join us for conversations with Bank of Korea Governor Ri Chang-yong live from the Singapore FinTech Festival. FINGMA's Vice President of Product will be joining us from the Seoul AI Summit. Plus, we'll get insights on tech from Google Southeast Asia VP Sapna Chada. And we talk market strategy with Yadani Research President Ed Yadani. So, plenty coming up next week. That is it for now for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.